Ladies and gentlemen, dear friends, welcome to this first SUERF ChiefEcon Forum. We are very pleased to have Philip Lane, ECB Chief Economist and Executive Board Member, has joined us today. Michaela Marcussen, SUERF Vice President, Chief Economist, Société Générale, will moderate the meeting.
Thank you very much, Ernest, and thank you to everyone for joining today. I'm absolutely delighted to be able to welcome you, and I think the timing of this event is particularly interesting. We've seen that we've come out of the severe shutdowns that we saw across much of Europe in the early part of the year. We then had that very fast bounce back, and we now seem to be moving into a new phase of the crisis, which I would be tempted to call living with COVID-19. And of course, this phase is one that's still shaped with very considerable uncertainty. But I also think what's interesting is we're seeing how the policy is shifting from an immediate response, which was all about protecting the economy in these more severe lockdowns, to now focusing increasingly on not just the recovery, but also the type of economies that we're going to be shaping for the medium to long term, with the focus on the digital transition, the focus on green transitions in many of the recovery plans, but also a broader discussion on new ways of working and new lifestyles that people are looking to. Now, of course, just zooming in on the monetary policy side, we also see a lot of questions coming out on this front, be it on the toolkits of the central banks, and of course that never-ending question of just what more the central banks can do, and just when we think they've done what they can do, they surprise us with something new and exciting in the toolkit. But also I think there's a broader question which also relates to the transmission of the monetary policy on just how low interest rates can go, so this question of the effective lower bound, just how we're going to manage these very large debt burdens that we see coming out of the present crisis. And when we just think back 10 years to the previous crisis, there was clearly a lesson that was coming through about how banks needed more capital and also how Europe needed a banking union and capital markets union. Well, I think we can say that the banks clearly came into this crisis with more capital. The banking union is there, but not quite complete. Capital market union still needs more work. But what seems to be emerging now as a new theme is that corporates, too, need more capital. So we see this interesting debate emerging on the dynamic between capital and debt on corporate balance sheets. And of course, all of this in a world which is shaped by at least what we're seeing now, greater protectionism. Clearly last week was an eventful one as far as Brexit is concerned. And of course, we also have that all-important US presidential election looming. Philip, I think you're, with your role, very well known to this group, and also with your truly excellent credentials. I think you're probably one of the best placed people in Europe today to comment on this situation. Now, normally when you imagine a fireside chat, I don't think you imagine that you would have come and found 52 economists, but here we all are, 52 of us ready to engage with you. So I'll hand over to you now, and thank you once again for joining us here today.
Thanks, Michaela. And of course, here today in Frankfurt, it's very nice late summer day, and the temperature in the high 20s. So far side doesn't sound too appropriate, at least for today. Now, actually, my kind of opening notes, Michaela, we're thinking along the same lines, which is basically we are definitely entering phase 3. So phase 1 was, from a central banking point of view, was the urgent need for market stabilization when the scale of this pandemic became clear mid-March. So the gigantic portfolio rebalancing exercise confronted all market participants, including a dash for cash. So it's fairly obvious and straightforward that central banks had an immediate stabilization role. Now, here we are in mid-September, coming to the end of quarter 3. In terms of the dynamics of the economy, again, quarter 2 and quarter 3 were never going to be too mysterious. When you have a big lockdown in quarter 2, and also, by the way, concentrated really in April, it wasn't the whole of quarter 2 by any means. Then, of course, you're going to have a really big drop in activity. And then mechanically, when you unlock the economy, there's going to be a very big rebound, which is really the story of quarter 2 and quarter 3 in the data. By the way, it does lead to the reflection, why are we talking quarters? I mean, as opposed to weeks or days or minutes, since we have so much real-time data now. But, in terms of the convention of having quarterly data, it doesn't quite fit at the moment. But, the fact we had a big drop and a big rebound is, maybe there was a high degree of consensus it would look like that. What's not clear is what happens next. And this is, the fact that at one level, as Michaela described it, is, how much do you want to live with this virus? What is the steady state in terms of keeping it at a low enough level that the pandemic doesn't resurge, especially in terms of hospitalizations and so on, while at the same time trying to keep an eye on economic sustainability. But that creates interesting issues both on the supply side and the demand side. So on the supply side, what we have is increasingly, if like the restrictions are very much concentrated, in the sense of even when a new city or district has to lock down again, it's not the case all economic activity stops. But what is stopping is, if you like, the contact-intensive sectors, restaurants, bars, and so on, retail to some extent, whereas large parts of the economy, especially working from home, can proceed. And so you definitely still have supply restrictions, all of those, and also the way everyone has to adapt in terms of social distancing, new ways of working. That is a restriction on potential output. But from a macro point of view, a lot of the unknowns are on the demand side. So this chart here, I quite like. It's about the savings rate for households. So again, it wasn't too mysterious. So if you go back over the history of the euro, the savings rate essentially fluctuated between 12 and 14% of disposable income. And you could have whole macro papers, I'm sure people have spent their careers writing about the fluctuation within that 12 to 14 band. And then, of course, they rocketed to 25%, at the peak of the lockdown. And, it's a real unknown territory, which is how does that unwind? What drives the unwinding of that very high savings rate? And what we're assuming in our baseline is it definitely did a sharp reversal now, but in no way did it go back to that 12 to 14 range very quickly. So in other words, we do think, to conjecture that precautionary saving will persist for a while. And that's partly because, as labour markets have to normalise in the sense of the blanket approach to labour market subsidies has to taper. And then, as Michaela indicated, not all jobs are coming back. What is going to be the new normal in terms of the future of different types of occupations? That naturally creates a degree of uncertainty for many workers. And, that's a very interesting issue in terms of what the economy looks like when the savings rate remains unusually high for an extended period. I mean, there's similar, considerations on the investment side that, again, capital goods producers are back in business, but increasingly the surveys are saying, well, actually I'm capable of producing more, but I'm fearful that that demand is not there. So in other words, we still have to think about investment demand as well. So for these reasons, even though we think there's a big recovery in quarter 3, there's still a considerable level gap to close between coming out of quarter 3 and where we should be at this point. And again, we're projecting under a baseline. It's going to take a while. It's going to depend on ultimately finding medical solutions, which of course is subject to a lot of uncertainty. So we don't think, by the way, I mean, the ECB and the others correctly in the baseline assumed it'll be a bumpy recovery. It's not the case that, so we do assume for the next year, there will be, fluctuations in the amount of localized lockdowns. So that's not a shock baseline, that is in the baseline to have, various types of, fluctuations in the severity of the pandemic. So under that baseline, the return to fully normal activity, we don't think is going to be until for a while. So the blue line is our baseline, and what you see there is really we're just back to the M19 level in late 22 under the baseline. So I think there's a few points to note here. Number one is one source of uncertainty resolved. So how bad quarter two would be resolved. Obviously, we now have the data for quarter two, and definitely quarter two came out better than some people feared. There's definitely, I think, at the time going back to May and June, a fear that maybe the baseline there'd be more downside risk to the baseline than upside, and in fact, the baseline more or less panned out. In fact, a little bit better. So if you reset the scenarios from the data we know in quarter two, there's still the message here. There's still a lot of uncertainty. I'm not a public health scientist. I don't have any inside information on vaccines. So whether we get the mild scenario, which is basically on an early vaccine discovery and an early and successful, generalized rollout of the vaccine, and you get a much closer to a V-shape, much more rapid bounce back. That's logically possible. And then the severe scenario is the medical progress is not there. We end up having to do more severe lockdowns. And then on top of that, of course, the longer various firms are incapable of earning revenue, the more distress you're going to have in terms of balance sheets and then knock-on effects in terms of that. So, I think, in terms of policy making, in terms of decision making, it's not so much about the point estimate embedded in the baseline. It's the fact this is, a really large range of uncertainty. So, right now, here we are coming towards the end of quarter three, and it's still the case, there's still a big gap to close. A lot of gap has closed, but compared to the normal type of cyclical fluctuation, the fact we might be, and here I'm just staring at the graph, I'm not telling you a particular level number, but staring at that graph under the baseline, there might be an 8 percentage point or so gap remaining to the pre-19, pre-pandemic level. That remains the case. There still remains a huge gap to close, even if there's a lot of progress has already been made. So this is I think going to be a big challenge for fiscal policy and for monetary policy. But of course, we know so far central banks have done what's obvious, but in no case is this the type of shock that monetary policy can solve on its own, and no one has suggested we solve it on our own. The amount of fiscal support, as Michaela indicated, has been very comprehensive and ambitious, which is very welcome. And of course, if you were listening to the Eurogroup discussions or the announcements to Eurogroup, it looks like that's going to continue in the European context into next year with the escape clause still active. So it's until this gap is closed quite a bit more than it is right now, having the kind of big support from fiscal policy is going to be important. And part of that, in terms of a reverse working backwards point of view, part of that does build into long term. We do have to think about, given we have a clear long-term agenda, we already had one. We already had a clear long-term agenda about the carbon transition, about digitalization, and so on. Given that we have this period of slack, underemployed resources, limited demand, in terms of the composition of fiscal policy, there's a very natural baseline here, which is to accelerate public investment plans that were needed anyway. So whether, directly public investment or other ways to help the economy move along those dimensions. I personally, again, have spent too much time on other dimensions about, the future of office working, the future of business travel. Of course, those are interesting conjectures to have, but even if you to take no strong stand on that, I think there should be a high degree of consensus about some basics such as preparing Europe for a more digital economy, preparing Europe for the carbon transition. And we do think, it's crystal clear under these situations, the investment multiplier from good projects has to be pretty high. So in terms of the setting of monetary policy, I think what we have now is, it's not too surprising that if you go from still a pretty big amount of slack in 2020 to more or less back to pre-19 levels of activity, in late 22, you should expect some recovery in inflation. So you should expect an upward profile in inflation, and that's what we have. But what it remains true is that this is still a lower path than the path we expect it to be on. And therefore, we do think we need to keep an eye on this. And in the projections, these projections, as we were indicating last week, in terms of headline, the headline number was suppressed a little bit by what's going on with energy prices. So even though, of course, the level of energy prices is a lot higher than we thought in June, the slope of the energy prices has moved a little bit, so which doesn't have the end of horizon inflation rate. And then there is a countervailing pressure in terms of both the recovery, because it definitely matters for output, and also for the inflation dynamic, which is the euro appreciation. So it's definitely has compared to what these projections would look like without euro appreciation, it does knock it back a bit. So in terms of the longer term campaign to get inflation back to our aim, the fact that the inflation path has been knocked down during this period is definitely a core focus of ours, is to recover the path we should have been on. Let me mention also that one of the big conjectures going into this is that credit transmission will be damaged, because clearly if so many firms are losing money, if there's structural change going on, it's a natural belief to believe that credit risks that banks need to assess. There's going to be all sorts of reasons for credit risk to go up. And this is there's been so far two responses. One is all of the moratoria and credit guarantees offered by governments. And then, through our TELTRO program, we've also been able to offset it to some degree through the incentive scheme we have, which lowers, basically it kind of has a kind of offsetting pricing impact on loans, which counters the kind of upward pressure on credit risk. But I think that's not a static situation. And maybe behind all of this is because, well, I'm pretty sure everyone on this call has complete understanding of this basic point. But I'm pretty sure also to the general public, it seems a bit mysterious. Where's all this money coming from is often the way it trades. How's this all financed? And, in terms of the kind of big picture issues, this graph shows, rolling estimates of where we think the underlying equilibrium real rate is. So if you go back to the late 90s, if the real rate was around 3, and if you were in steady state and inflation rate of 2, that meant the policy rate would be 5 in the late 90s. Even in 08, if the real rate, the equilibrium rate was around 2, and you had in mind a steady state inflation rate of around 2, then the policy rate would be 4. Now, when our estimates are 0 or below, let's use 0 as a round number, and we want to get to a 2% inflation target, more or less, then, if you like, the kind of normal times policy rate will be 2. And so, if you like, let alone whatever cutting you do in the middle of a crisis, if the nominal interest rate over the cycle is 2, then the kind of calculations about public debt, calculations of private debt, calculations of banks, corporates, and so on, are fundamentally different to 10 years ago or 20 years ago. And this is really, behind this unique environment we have now, which is basically, the ability to sustain high levels of debt. Now, we've all been involved very much in debates about whether this is forever, whether it's how quickly this might reverse. And some of the, there are engines behind this where, partly is that because some of the fundamentals of what's behind a low or star includes people like Larry Summers were focusing on fiscal modesty. Well, we no longer have fiscal modesty where governments are not doing enough to sustain demand. Attitude to risk, however, is a big part of our star. And so it's a big long-term conjecture, which is, will the lesson coming out of this be, look, really terrible shocks can happen, and individually we should prepare for that with a big proportionate buffer. Of course, collectively there is a paradox of thrift. If we all save too much, then that puts downward pressure on the equilibrium real rate. The alternative interpretation is, of course, you can say, well, when bad shocks happen, policymakers react. And in fact, there's enough support from labour market subsidies, subsidies to firms and so on, that rather than individuals having to prepare, it's really a lesson in having kind of crisis-ready policy frameworks, which I think is a interesting long-term issue.
We already have a first question coming in here relating to the effective lower bound and how this is influenced by the ECB's tiering system for bank reserves. And if we move to an environment characterized much less by market fragmentation to one where the firmer exchange rate becomes a more pressing consideration in terms of its deflationary impulse, then the question becomes, is there more scope to lower the policy rate considerably? So this is a first question that we have, and I think I'll take a prerogative and also throw in a second question, because one of the things that really strikes me in the discussion on the declining natural rate of interest is just how strongly it ties in with declining levels of productivity and historically rising debt levels. And I wonder if there's a more structural question here on when we think about the type of investments that typically get financed by debt as a very broad brush and perhaps slightly crude way of looking at it, is quite often we can think about investments that get financed with debt as being slightly less productive and perhaps less innovative than the investments that get financed through equity capital. And I wonder if we should be rethinking the way also regulation treats debt and equity, for example, on the balance sheets of insurance funds, various savings mechanisms, and whether we should somehow think about encouraging more use of equity to get more productive capital and somehow ease our way out of this very low real rate environment.
Interesting questions. Maybe on the effective lower bound and the question about tiering. I mean, I think it's important to recall, of course, banks are super important. We are a bank-based financial system, but banks are not the only participants in the wholesale markets. And, that's another recurrent theme of everything really, is the role of non-banks in financing the economy, both in terms of debt, but also, as you just indicated, in terms of equity. So when we think about the effective lower bound, there is a subset of questions about the banking system. And of course, one element of that is, as you just indicated, whether in terms of net income, there's some offset through tiering. Now, of course, there's other programs we run, including in particular TLTROs, which very much are bank focused, very much alters the relationship between central bank funding, excess reserves, and so on. So I think any discussion about tiering has to take into account in a holistic way, in a kind of aggregated way, all of the relationships between the banking system and a whole set of programs that we run. I would invite everyone to also recollect there's really two lower bounds. One lower bound is maybe the historical lower bound, which is what is the lower bound at which enough people convert to holding cash. So you build your vault, because that's traditionally say, well, you can't go too negative because people will just hold cash, currency, banknotes, as opposed to tolerating negative interest rates on their bank accounts. So that you have to keep in mind that that's one type of lower bound. And then the other type of lower bound is essentially where it becomes counterproductive. So this is the reversal rate idea that let me say I agree. There's going to be some number below which even if you can put the rate more negative, it may turn out to be counterproductive for all sorts of reasons. So we obviously I think have to be recognized that other central banks have a lower policy rate than we do. So we have some evidence of policy rates going more negative than minus 50. We also have to recognize, we have an evidence bank. The latest cut we did a year ago from minus 40 to minus 50 and the previous. So of course we look carefully at the transmission of all of that. And let me point out, there's crystal clear that the transmission mechanism still operated, i.e. when we put the policy rate, it did transmit in the normal way with the normal elasticities into cuts in lending rates. So in terms of being an effective transmission mechanism, in terms of getting into the real economy by intermediation, pushing down lending rates for households and firms for the real economy, it absolutely remains effective. So we don't have the kind of indications that we're hitting the lower band, and that's why we are comfortable in our forward guidance to remind everyone that rates will be at their current or lower levels. So I think it does remain something that we look at all the time. But the economics of interest rate cuts, back in March when we chose these asset purchases rather than a rate cut, I made the point then, which I think is correct, which is that a rate cut is typically most effective when everyone believes it's going to be there for a long time. So it's a very persistent cut. So if you cut the policy rate and then it's expected to remain at the lower level for several years, then the term structure will move. If you cut the policy rate for 6 months, then the longer part of the yield curve is not going to move in the same way. So, and even though we think this is a very large shock, we are saying also that it's temporary in nature, that it's not the case that this is the same kind of open-ended shock as a lot of shocks are negative for inflation. It's also the case the kind of power of a rate cut does depend on the intermediation process. So, in other words, that part of that is a low short-end rate encourages various types of intermediaries to switch to longer end. But of course, in the middle of what we saw in March and April and so on, intermediation was a challenge, to say the least. So using the asset purchase program was, very efficient and effective way to respond to that shock. All of the issues about equity versus debt, and so it's an interesting issue. And Mario Draghi gave an interesting speech in Rimini there a few weeks ago about good debt versus bad debt. And it's an interesting issue about under what conditions is a lot of debt in line with good governance, versus under what conditions is a lot of debt kind of recklessness and gambling for redemption and perverse. And you can definitely come up with both scenarios. We've seen plenty of examples where the incentives were at least at an individual level was to overborrow. So high debt is a sign of a problem. But, I think also many people will also in corporate governance will point to excessive amounts of equity capital as a problem also, because in terms of, when you think about the gap between the manager's incentives versus the shareholder incentives. But I'm not going to disagree with you that in general, more equity would be a good idea. But it's a little bit, I mean, I have often read policy recommendations is let's advocate for more equity and less debt. But, you know, and someone, you know, working on how to, it's so embedded in tax systems, it's so embedded all over the place that, you know, we can all say it, but actually moving on that is, you know, someone should dedicate their lives to it. I don't disagree. You know, I think, but let me say, I mean, is it the case? I think you mentioned that debt levels have gone up, you know, which of course is true at one level. But you know, but that's partly in response to, you know, so of course it's causation both ways. Low rates versus encouraging high debt because it's easier to service. And then high debt, you can, you know, conjecture how much that matters for low rates. But I mean, I think it's important, and you know, I permanently am saying this, is you have to look at the whole economy. So high public debt in a situation when collectively a given country is running a gigantic current account surplus is very different to the twin debt or twin deficit situations we've had before. Because, you know, in terms of the macro situation, you know, if a high public debt is also high external debt, and chronically a country faces, you know, an indefinite future of big trade surpluses, that's very different to a situation where a high public debt is essentially a transfer to domestic bondholders, because the macro consequences of that are very different. So, you know, any discussion of the high sovereign debts we're seeing has to be matched from a euro area perspective with, okay, well, let's look at the whole implications of this. Because remember, I mean, right now it's replacing, we know, for example, households have very high savings rates right now. We know the corporate sector is unlikely to be doing a lot of debt finance investment. So we do have to think about this from a macro equilibrium point of view. But there's no doubt, because it's, you know, it's not too easy to find historical parallels. It does require a lot of thinking.
So we have quite, so thank you for this, and we have quite a flurry of questions coming in here. So I'll sort of just try and group a little bit. So there's a bunch of questions which relate back to how worried the ECB should be about the inflation expectations, linking into how worried the ECB should be about the euro, and perhaps the interesting question of how worried the ECB should be about competitive easing between central banks. Indeed, it seems that the Fed is keen to let the markets know that they could do yield curve targeting, even though they don't think they want to do it right now. There is sort of that hinting of this new policy tool, and a question of whether we could end up in such a competitive easing, and then linking back into this, what to make of the growth of monetary aggregates relatively on across the Atlantic. So that's sort of one family of questions, which I'll send your way, Philip. There's another family of questions which relate, of course, to the hot topic of the day, probably with the headlines we saw last week on Brexit. Clearly, the risks of a no-deal Brexit, and perhaps a slightly disorderly one. It's not every day you see a government minister admitting to breaking international law, be it in a very specific and limited way. So this question of what we should make of Brexit and the risks that may entail. And Beake Javorcik would also like to ask a question. So what I'll do is I'll just hand over for that question to be asked as well. Beate, please go ahead.
Yes, thank you. Let me just start with a comment. You were mentioning that tax systems have for a long time have this embedded preference for debt versus equity. But if this is ever to change, you know, when would be a better time to make this argument than now? right? So perhaps now it's something we should be thinking about hard. But my question is about policy spillovers. What are the impacts of ECB policies on non-Eurozone countries, both those within the European Union and those outside? And what do current events mean for possible expansion of the Eurozone for new countries adopting Euro? Thank you.
So, Philip, a little bit of a broad set of questions there, but I'll let you pick up on some of these different threads, and
okay.
Very keen
Sure.
to hear your thoughts.
Okay, I mean, I think definitely we can definitely think of the euro as a regional currency, that it matters not just for the euro area, but definitely also for the wider European geography. I mean, that's for sure. As you know, there's plenty of euro-denominated activity in the financial systems of various neighbouring countries. And to that extent, you know, the spillover is positive. I mean, if we ease monetary conditions, then these systems, which have a lot of euro-denominated activity, will also see the easing. So I'm pretty sure the spillover is positive from that point of view. As you may have kept track, you know, we've been active at that regional level in terms of swaps and repos, also to enable the central banks of these countries who've signed up for these agreements to obtain, you know, to have the option of raising euro liquidity from us. So I think we're playing our kind of important regional role there, which I think is win-win. It's good for us to have that, to make sure there isn't negative spillbacks from any liquidity issue elsewhere in the neighbourhood, and also provide the stabilising force for these countries. So I think at that level, you know, I think de facto, you know, in the same way when the Fed eases the global dollar system, you know, the whole system that uses dollars benefits from that. I think that's right. The Brexit issue, yeah, I mean, we think, so I mean, I don't spend time trying to calculate the probability of a disorderly Brexit, you know, but as a conjecture, it's definitely, and so, you know, we are, you know, in terms of what type of Brexit we're going to get, it's going to be something that definitely feeds into how we think about the economy. Absolutely. So, you know, we've definitely worked hard to try and think about the impact. Of course, there is a basic asymmetry. You know, UK is a very important trading partner for the euro area, but compared to the size of the euro area, it's just one trading partner. Now, it will affect some member countries more than others, but in the aggregate, it's, you know, it's obviously a concern, and I hope it's not a disorderly Brexit. Definitely hope that an agreement is reached. Coming back to inflation expectations, I mean, it's a very interesting issue. So, again, as I just said, I mean, I don't, honestly, and I don't really think whether it's ECB or the Fed or the BOJ or PBOC, any major central bank, I wouldn't think about any policy making because it's all domestically orientated. I mean, at the margin, you know, of course, in the full calculation, the full general equilibrium, the impact on the rest of the world is part of and then the spillback from the rest of the world back to the domestic economy does matter. But you know, it's clear we all have domestically orientated monetary policies, which are by and large focused on an inflation target of some type. So this phrase of competitive easing, I just don't think, because that sort of suggests that the competitive angle is some angle that can be separated out from the general orientation of monetary policy, which you know, for a small country which is target, you know, keeping an eye on the exchange rate maybe, but for a large central bank, the easing decision is driven by where you think the inflation path is going. There's no question about that. And so, you know, I think I just totally reject this phrase in competitive easing. Now, of course, the spillovers matter. They do feed in. We're big enough, the Fed, to affect U.S. macro indicators, the calculations show that. Equally, let me make an important point about this because, in our modeling, it's the rest of the world. Obviously, the U.S. is in the rest of the world. But please remember, the size of emerging markets in global GDP is so much bigger than it used to be. And this particular episode is we have easing by a lot of countries. So traditionally, in a big global shock, to be by necessity tightening in various emerging markets because of currency risk. On this occasion, we've had significant easing by lots of major emerging market central banks. And when you convert, all of those individual decisions into an aggregated rest of the world, that's relevant for us. So it's important to think about that full global equilibrium, so I think there's no substitute for a macro model here when you think about global output matters, global domestic activity everywhere else matters, and then of course the exchange rate matters as well. But it's important not to go one by one. You do the full general equilibrium. You feed that into your macro model. Not one model. There's many models, and then we look more or less at the kind of a median outcome of that. And so, the exchange rate does matter for our inflation forecast. The trade-weighted exchange rate, there's no doubt about that. But you also have to think about other factors influencing the inflation forecast. So, we're definitely driven by what's happening to our inflation forecast, and that's why we mentioned last week in the policy statement about the exchange rate. But in this period where we have the uncertainty about the pandemic, we have to take into account what's going on with other policy dimensions. I phrased it last week that we'll have a richer information set in the coming weeks. By the way, on inflation expectations, there's all sorts. Obviously, at some level, the expectations of financial market participants are important. In terms of asset pricing and so on. But it's definitely true also that, it's very important and interesting to think about consumer expectations. And so we're now, learning a lot more from our consumer expectation survey. We started this late last year as a pilot, but we now have it, up and running in a fuller scale. And we're learning every month quite a bit about, not just about inflation expectations, by the way, but attitudes around Europe of households to uncertainty, to unemployment risk, to precautionary savings. So we really value having a richer information about what's going on in terms of the psychology of households. It's an interesting issue about the pandemic and formation of expectations for the medium term. Because, to the extent the pandemic is really a one-off, if correctly handled, if we get out the other side of this, will the experience during the pandemic be seen as representative, or will it be kind of isolated? Say, well, okay, that's kind of an emergency phase, and how much of what went on in the emergency will affect the steady state.
So we're getting a new batch of questions now. They seem to be flowing in a bit more quickly than I can keep track of at the moment. So there's one here from Peter Brezhnik. Why is the ECB so much worried about low inflation and even deflation is important in sectors? So technology. So I suppose, Philip, this is more about good and bad deflation. Technology doesn't cause demand output, but more important, the CE economies like Poland, Czech Republic, Hungary, Slovakia, and more have shown deflation from 13 to 16 in 3.5 to 4 consecutive years, associated with accelerating GDP growth and even the significantly above. is the evidence of no negative impact on deflation on GDP growth not an argument not to fear deflation quite so much? So I think that's sort of one angle of a question that we're seeing coming out here in the debate. And then another question which also comes back to and links into all of this is the question of whether the ECB is concerned about the increasing side effects from ultra-easy monetary policies such as asset price exuberance, a long-term dampening of productivity and potential growth. And this is, of course, linked into the whole sort of zombification argument. So clearly we're seeing some different issues coming about here, the question of good, bad deflation, and also which links into the question of good, bad debt that we talked about earlier, and to the extent that it may cause zombification. I thought it was very interesting also what you mentioned about the consumer expectation survey, and I think this is certainly a wealth of information which is incredibly important. And I also think it links into the rather circular nature of the market inflation expectations, because of course these contain both an inflation component and a term premia, and much of the policy conducted presently by central banks is of course also compressing that term premia. So I wonder if we shouldn't be a bit more critical in thinking about the market inflation expectation and breaking that down. Now I realize that's once again, Philip, a rather long list and perhaps slightly eclectic questions coming, but that's what happens when you bring together 50 economists like this. So I'll just hand over to you and perhaps let you pick up on some of these various threads, and I'm sure we'll have some more questions in a minute as well.
Okay, thank you. I mean, when we look at financial, market-based expectations, we absolutely have those two angles of, we don't think the price is a pure mean expectation. There's definitely the premium in there as well. And we spend a lot of time chopping it up into the two components. But both, by the way, have a role. I mean, let's imagine the market has stable expectations about the average, what they expect to happen. But they put more and more weight on risk, deflation risk, for example. I mean, that's still consequential. We do think about the whole distribution of outcomes, not just the point estimate. So at that level, typically, when we see a decline, it's driven by both. It's driven by maybe some lowering of the mean, but also an elevation of risk. And the policy message is essentially the same. So from the point of view of policy making, both matter. I mean, it's very interesting about deflation, inflation, and the core point when people talk about individual is there's a massive difference between relative price movements and real exchange rate movements, and genuine deflation and inflation for that matter. I mean, you can only really think about deflation and inflation in the context of a inflation targeting central bank. So when you have a new member state catching up, where hopefully there's a lot of productivity improvements, and when you have a situation where also maybe some artificially administered prices are liberalized and so on, you can definitely have periods where prices are falling, but that's not deflation. That's basically real exchange rate adjustment in my book, anyway. And I think increasingly the analysis of deflation or low inflation is really reinforced by this pandemic shock, because on top of all the traditional reasons which still hold more or less, the single biggest issue now is, as I had in my presentation, which is, let's imagine the real rate is 0. And if your inflation target is 2, then, under a steady state, your policy rate would be 2. And therefore, when a negative shock comes along, you have a fair amount of conventional policy space to use before you start turning to asset purchases or going negative or whatever. Whereas if your real rate is 0 and your inflation target is 1, or let's say 0, then, just basically from a cyclical management point of view, it's very difficult to use monetary policy. Yeah, so let's use zero. So I mean, if the policy rate is, if you target inflation of zero and real rate is zero, then any type of negative shock, you have to immediately go to asset purchases or a negative rate. So this is, compared to the debate 20 years ago, we now, when the real rate, let's say, was around 2 or 3, this is just such a gigantic extra issue, which really kind of reinforces the case for picking a positive inflation target. And I think that just dominates everything else. And I think that's just, it's a kind of dominant argument. Side effects. What's very interesting about the low equilibrium real rate, at least outside of the US, is it's not particularly the case that we think the equity risk premium has come down. So, the kind of exuberance mentioned, it seems around the world that there's a lot of desire to hold safe assets. But that, if you buy that argument, you're also stipulating there's a less desire to hold risky assets. And therefore, it's hard to build a kind of generalized exuberance argument if you believe in the safe asset story. In addition to that, one of the big, I think, successes of the intellectual framework in Europe now is accepting that macroprudential policy is fundamental. That if you do see more risk-taking, say, in the real estate market, then the kind of surgical approach to that is to use a combination. So whether it's loan-to-income, loan-to-value ratios in terms of the borrower, in using various type of charges in terms of supervising risk-taking banks and so on. Is there ways to address that directly? Because we know, and I'm sure that many people on this call have worked on it, it's very typically, it's going to be very crude to modify monetary policy when macroprudential policy can do a much more efficient job. Now, I think every central bank will say, well, we reserve the right, in maybe intense phases of risk taking, also to change monetary policy, which I would see the case for. So it's not the case that some kind of iron law that you would never modify monetary policy to deal with financial stability risks. But, I think there's a lot you can do before that. On zombies, I find this argument, when you have an underemployed, so where's the pressure on zombies? Is it the case that they are keeping themselves open because of cheap financing? Or is it the case that basically in a kind of non-vigorous economy, the competitive pressure is not enough? So in other words, if you had a fully employed, well-running economy, zombie firms would not survive because their workers would be hired away by more successful firms. So I find, in terms of the ordering of what is the kind of truly most powerful factor in explaining the survival of low productivity firms, I'm not disagreeing. There might be some contribution from cheap financing, but I would have thought that the bigger contribution is until you hit, kind of full use of resources, the kind of opportunity cost of keeping zombie firms, running is obviously less than if there's a kind of opportunity cost that other firms are constrained because zombie firms remain alive. So I'm not so sure about that argument, but we definitely can look more at it.
So thank you, Philip, and I think you sort of opened up the door here to a few questions that I'll take the liberty of asking while everyone is thinking about their own questions. The topic of safe assets sort of popped in there to the debate, and as you probably know, that's one of my own favorite issues, and I know you've done a lot of work of it as well. And there seems to be sort of a small door opening here with the idea that now that we have the next generation EU of a fund of 750 billion, giving rise to a much larger issuance by the Commission, some have suggested that this may give rise to a a much larger safe asset in Europe, and perhaps open the door to advancing more quickly on the banking union. Now, I have my own rather strong views about that, but I think the audience will be much more interested in your views on this and what you see as being some of the hurdles in advancing the banking union. This is a first question I have for you. A second thing which really strikes me, and I think the second question you opened up to on macroprudential is a really important one. And it strikes me that so far the macroprudential tool, as it's been used in Europe, has been very much focused on the bank lending channel and less focused perhaps on the channels of market lending. And we've also seen that the appetite to use the channel through the housing market has been a bit more mixed, no doubt, because of some of the political and income distribution or sort of the households that get hit hardest by some of these measures potentially. So I'd be very keen to hear if you think that there's more work to be done in the macroprudential area, and especially in looking at macroprudential in relation to capital markets.
Yeah, no, so you put a lot into all of that. So let me split it between the safe asset question, which you kind of morphed into a banking union question, and then the macroprudential issue. So adding 750 billion of EU issued debt clearly expands the set of high-grade euro-denominated bonds. I mean, in the Safe Asset Task Force that I chaired a couple of years ago, we were quite impressed by the fact that if you take a global investor base, anything that's kind of EU level issues is so popular with the global investor base. So, and this is really going to add to that. So, I'm sure there's going to be very high demand for the new issuance. So, I think that's very welcome. But I think it's important, of course, it's possible to conjecture about what this means for the future. But I think, that's going to take some time. It's going to take some time about whether, will this fund work well, on all sides in terms of the raising the finance, and then whether it's used efficiently, everyone has to write their recovery plan, and whether in the end it does what it's designed to do, which is to make sure we have much more even, safer recovery across the whole EU. So I think it's a really good development, and I think it's very clever, and I look forward to seeing it in action very soon. But I think it's fundamentally different to the debate that we've all contributed to in different ways about a steady state. So I don't think we can read into this particular initiative, which is clearly related to the pandemic, clearly related to a very large negative shock, whether that has implications for the steady state or not. Let's see about that. Now, of course, having an area-wide euro-denominated safe asset makes some dimensions of banking union a lot easier. There's no doubt about that. But let me, I think the Eurogroup at the weekend was reinforcing the importance of moving forward with banking union. I think it's absolutely, a very good idea to move forward along all dimensions with banking union. It really is a core to a very, making the monetary union much more stable. But of course, behind all of this is really, and even come back to our monetary policy, again, this diagnosis that the collective banking system in the Euro area needs to consolidate, and that consolidation is very important in order to provide the room for it to combine all the investment it needs in terms of digitalization and so on, with earning a decent margin and so on. So I think there's a lot of moving parts to that. I think Aussie Capital Markets Union is very complementary to banking union. I mean, I think at a very most basic level, you know, some of the most tradable securities are in the equity and the bonds of banks. So having, you know, cross-border consolidation banking sector is also very much a part of also moving on Capital Markets Union. On the macro-prudent, let me mention a few things. You know, if you have borrower-based regulations, it doesn't matter if the lender is a bank or non-bank if you operate on the borrower side. And, you know, that, of course, as you indicate, the political system has to be willing to live with restrictions on the, you know, freedom of individual households to make decisions about how much debt that they're willing to have. By the way, even on I mean, I'd also maybe there's some types of tax measures, which, you know, are tax measures rather macroprudential, but maybe can play a role with certain types of non-bank investors. So again, if you think about things like commercial real estate, other areas where maybe there's a lot of non-bank intermediaries, the kind of any fears about overinvestment or whatever in a certain category can also be dealt with through tax policy. I mean, the wider issue about financial stability in non-banks, you know, which has been a big topic this year, about how do you stabilize the financial system where funding is not through the, because we know how to stabilize banks, but how do you stabilize a financial system which also has a lot of non-bank intermediaries? You know, I think it remains something that we, the ECB, would highlight quite a bit as a big issue. I think, let me stop there.
Thank you very much, Philip. We have a few more questions popping in here, and one which I think is quite fun, probably it's just the type of thing that economists think are quite fun, is this new debate on all these alternative indicators we've seen pop up through this crisis, be it, you know, the various mobility data that we've seen popping in, and other high frequency data, you know, motorway tolls and all sorts of things. How are you using these at the ECB, and is it something that you're integrating into your framework? And do you think that these new high frequency indicators, which obviously have a lot of their own issues, I wonder how they get seasonally adjusted personally. Do you think they're here to stay? Is this going to be a new normal thing that we'll sit around on a daily basis and watch all the mobility data? So this is a question that came up here. And also sort of related to this is that everyone is using scenarios, and at the same time, we all come out with scenarios with quite wide ranges on them. You know, if you made a half a GDP point change to your forecast previously, that was considered a major change. Now that's just within the realm of uncertainty, and even more so. So how should we think about these scenarios, and how can they really help us make decisions and deal with this uncertainty? And perhaps also linked into this, also help governments correctly calibrate fiscal plans, because one thing is calibrating monetary policy, which where we have decisions, you know, 8 times a year and potentially more if needed. Another thing entirely is to calibrate fiscal policy, where we know the process tends to be much slower, especially when we're not dealing with a sudden stop linked to a pandemic.
Yeah, no, that's an interesting set of questions. All right. So, I mean, I would agree that the value of some of these alternative indicators is extremely useful when you have a really large shock. Because, of course, when the nature of the shock is to immobilize people by keeping them at home, mobility data is very interesting to think about. Well, have we immobilized the population? And once you start to unlock, are people moving about again? So, I mean, that's directly interesting. It's not that it's a proxy for anything or it's a kind of good forecast for anything. It's just directly interesting when one of the most basic policies is restricting mobility. So mobility data is directly interesting now. whether it's always going to be directly interesting, I think is open to question. I mean, I think what's interesting, maybe most interesting, is kind of daily indicators of expenditure. So having payments data, credit card data, and so on, which are daily, that's much more directly feeds into conjectures about consumption and so on, and activity levels. And again, as we are moving from a very large shutdown, it's interesting in the bounce back. But the previous experience with real time and high frequency is the noise to signal ratio is quite high. So it's not the case that necessarily any of this will map into something that's useful in steady state, because the fluctuations that are smoothed out in monthly or quarterly data, you have to deal with every day. I mean, should I pay attention today or should I not? Should I pay attention this week or should I not? So there can be, having said it, there can be a value actually to just sticking with the traditional macro series. I'm sure there's more value if I was trading a portfolio every day. I'm sure there's more value, but when we're basically setting monetary policy to influence the medium-term path of inflation, the value of super high frequencies obviously diminished by that. So I think it's interesting. You can have to remind me, Michaela, what your second question was. Oh, sorry, the fiscal. I think on fiscal, part of that can be managed a little bit by, first of all, which I think is happening a fair amount, is recalibrating on a frequent basis. So it's not the case that typically any kind of labour market subsidy policy or other types of subsidy policies are kind of, the parameters are not fixed forever. So it makes sense, to come back and revisit, to look at the level of the payment, to look at the generality, is it for everyone, is it by sector, and so on. So fiscal policy does have to probably, under these conditions, be set on a more frequent basis. But that's essentially been happening over the last number of months. There's lots going on outside of the normal budgetary cycle. I think this is very much unique circumstances, it's very hard to make too many predictions. And going back to the issue about scenarios, and so I mean, there's two issues there. One is accepting the error rate is going to be big, but then for policymaking is making sure the policymaking is robust, because clearly you don't want to put all your bets on the baseline. If the baseline, because there's so much uncertainty around the baseline, you have to make sure that the policymaking is robust, which is obviously probably easier with monetary policy than fiscal.
So indeed, I would share your view on that, Philip. And I think one of the big concerns I have on the fiscal side is that one thing is to come up with and vote through public investment plans on the digital and green transitions. And these are, of course, very welcome. But what we often see in practice is that these plans are, one thing is to get them through and get them voted through parliaments. Quite another thing is to implement them, get the planning permission, make sure these public investments actually get put into place. And it seems to me that many of the plans today have a rather ambitious timeline for these public investments. So my first question to you on this is just how do you deal with this implementation risks and thinking about the forecasts at the ECB? Do you have an assumption about how quickly public investments can in fact be rolled out relative to the ambitions? And then there's a question popping in here on the high debt levels. Again, and how we resolve it. Now, I think you've sort of indicated to us that the way you resolve it is make sure you keep nominal GDP growth well in excess of a nominal interest rate, so over the longer term. But I suppose that there is also a political dimension to this, and thinking about some of the public spending programs that are being put in place today, and as to just how long we'll have to continue running them. One thing I just wanted to pick up on, and I'm conscious of your time here as well, and I would say, we've sort of reached that moment where I think in the UK they say we're getting to time, so it's sort of last time to send in a few questions here. But I think, you mentioned this 2% level a few times in the consideration of the nominal interest rate. But one thing that really strikes me is that during the recovery phase, the ECB never really managed to get to a point where there was significant room for rate normalization. And my question to you is, how much of that do you think has to do with the fragmentation that we're still suffering from in Europe?
Okay, so I mean, I think, of course, we all advocate for investment project execution, which is as efficient as possible. Of course, every country has its planning system and so on. But I suppose, people often say, well, it's going to take so long from, but probably the first response to that is, well, if it takes so long, you better get going. It's, otherwise permanently you don't do public investment. If you say, I'm not going to do public investment because, and I think that's even more so under this scenario because, we do think it's a temporary shock, but it's also the case that having the kind of security about the medium term, we know what happened after 2010, 2013 is that we had a very slow recovery and partial recovery. So and that's why I think the 5-year horizon of the EU Recovery Fund is so important, is we do have a vision of the post-pandemic economy, that we do have kind of important stabilizing anchors, including the fact that there's a 5-year horizon for the next generation EU program. So I think it's, to de-emphasize the role of public investment in kind of the cyclical components of recovery, as opposed to being a kind of important basic anchor for the longer term. So I think, on that basis, I think we should think about it. Because, it's very difficult to think about public investment in the super short term. But beyond, I think that there are things you can do short term, but a lot would be medium term. On high debt levels and public spending, I suppose I have a very general comment there. It's just very important in every country. It's very important not, it's important, it's still country specific, because what is true is that, at a high debt level, the debate about public spending should be closely aligned with the debate about taxation. That, in this current period, of course, there's a delinking, that public spending is going up and tax revenues are going down right now. But in general, the debate about public spending in steady state has to be linked to tax. And that's never an easy conversation, but that's going to be the basic, link there. So I don't think I would make a direct connection between high debt and public spending unless you're prepared to explain to me the role the tax system is going to play. So I'm going to, if you think about that period, especially like 2017 and so on, when there was a good recovery in Europe, it remained incomplete. So some parts of the euro area, yes, would have been, more or less a full employment. When you take the euro area in general, it was incomplete. So you phrase that as fragmentation. It's definitely geographically incomplete. If we reserve fragmentation for thinking about fragmentation of the financial system, it was not the case, particularly at that time. The financial system was fragmented. I think in recent years, lending rates, yes, they're still different, but lending rates have come down a lot. I don't particularly think the financial system was the barrier. It's just basically the Post-crisis adjustment was at different places, and then, of course, different in terms of steady-state productivity policies and so on. There are differences. But I mean, if you look at other big monetary areas, inflation was low as well. It was not the case that, yes, the Fed was raising rates to some extent, but of course, under their current policy, this view about where's the trigger for significant inflation might be moving. So I think I think the orientation remains absolutely correct for the reasons I gave you, that the orientation of central banks to having, getting inflation back towards somewhere in the zone of 2% remains long-term fundamentally correct. But when we have the policy space that we have, and as the ECB was doing during those years, and they continue to do, it doesn't happen overnight. And then I think in those years we did have the asymmetry, which is the monetary policy was expansionary, the fiscal policy was remaining in rebuilding mode, rebuilding the fiscal space. What we have right now is both are going hand in hand, both are counter-cyclical at the moment. And that's going to be one of the big questions is as we come out of this, is the relative contributions of monetary and fiscal policy.
So thank you very much. We have a final question here from Reto Kuni. So I'll just hand over for that question to be asked. Reto, please go ahead.
When I look back to Mario Draghi's speeches in 2014, 16, and also then at his look-back speech in 2019, Mario Draghi referred very much to the fact that actually the ECB has a quite symmetric inflation targeting, in such that he referred very much to the sense or the idea that after a certain time below their close but below 2% inflation target, that the ECB should now also let inflation be above the 2% inflation target. So I wondered right now why, after having a lot of media attention for the Fed's average inflation targeting, not the ECB raised these points and somewhat maybe could have dampened the pressure on the euro.
I don't really think there's any uncertainty about our commitment to symmetry, but I think it's fair to say the word symmetry is interpreted by different people in different ways. I mean, I think last summer we introduced it as a core part of our communication because, the ECB, I mean, the more basic issue with symmetry, which is, the Governing Council is clear on, is if you believe we were indifferent about inflation falling below the target, so long as it's above zero, so long as we had price stability, but we would crack down whenever inflation went above 2, then I think we've clarified that we're symmetric in that inflation shortfalls are consequential and invite a reaction from us as an overshoot. So that is really I think the most fundamental issue with symmetry is we do think periods of undershoot are costly, not just periods of overshoot. And that needed clarification because of the way we've defined price stability. It wasn't obvious to everyone. So, we have a kind of clear view that we will fight below target inflation as much as we will fight above target inflation. Then the question is, well, to anchor inflation expectations, to make sure inflation expectations don't get disanchored from the aim, how do you do that? And I think, as was, in the speech by Mario Draghi and as in the Fed's new strategy, one way to do that is to say, look, we're going to target average inflation. And this is why we have a strategy review, which is, we're going to be busy with for the next number of months, and the academic literature, by the way, has a wide range of variations. So, but I think anyone who pays attention knows all of that will be covered by our strategy review. And, I think it's going to be, clear that we have to look at it. And I really I personally wouldn't put too much weight on uncertainty about the final outcome about that as a big driver of anything. Because I think the underlying commitment is there. We take a symmetric approach. We're not happy, and we will respond if inflation persistently falls below the target. We don't declare victory if inflation is positive but below 2, and that's crystal clear by now.
So, Philip, there's a final question that's just dashed in here before the bell rang. And it's quite an interesting one, I think. So basically, the question is, the lending rate on TLTRO3, which can currently be up to 50 basis points below the policy rate, how would you see the scope to increase that gap further? And would there be any circumstances on which that gap could be increased?
So when we made that decision in the spring, we put it in our communication that this move is an example of using the TLTRO calibration as an active policy tool. So we don't ex ante decide here's the limit. Because remember with TLTROs, the kind of because it's the volume ceiling, we say half the eligible loan book can be pledged in order to tap TLTRO funding. So it's not like the policy rate where there's no quantitative limits. The policy rate has a very general impact on the financial system. TLTRO pricing, there's more degree of freedom there because we put a volume limit on it. So in that sense, I think we think it's been very successful. We're very happy with the way TLTRO3 is going. Of course, it's still early days in terms of the full dynamics of how the funding is going to be used. But we do think that this basic design is quite successful. But just as a reminder, it's because fundamentally it has this volume limit, the kind of economics of it is quite different to a general rate cut.
So thank you very much for that, Philip, and thank you so much for taking time to join us today. I think the scope of the discussion we've had really shows that monetary policy has become far more complex over the years. I remember the days when central bank policy was just about, will rates be kept on hold, hiked or cut, and it was all rather straightforward. Clearly the complexity has changed tremendously over the recent, basically since the great financial crisis. So thank you so much for your patience. One of the things with these virtual events is it's very hard to do applause at the end, but I think everyone will join me in giving you a great big virtual applause here. So thank you so much.
Okay, thank you. Thank you for all the questions.
Thank you. Thank you very much for everyone for joining today.
Bye.
Bye-bye.
Bye-bye. Thank you.